One of the biggest topics that investors discuss is the moat of a company, how strong or weak it is. For every investment you make, you want to buy companies that have great moats. They're competitive advantages. It means that other competitors can't compete with this company. Well, today we're going to be looking at 33 of the most popular companies in the market and ranking their moats. We're going to be putting them into 5 different categories. I have them listed out here. Stronghold, the very top. These are companies that have such strong competitive positions. The durability of their income, the predictability is so good that they're virtually unassailable. Then below that, we have Castle Wall. Incredibly strong companies, but not quite in that category of the stronghold. Then below that, we have the wood fence. These are companies that are more in the average size with normal moats, not the strongest, but they have some competitive positioning. Then below that, we have a picket fence. These are companies where they might have some moat. And below that, we have an open field. Those are no moat companies. And we'll be looking at all of these stocks, all the most popular stocks in the market that you're looking at and discussing, we're going to be ranking. Now, to start things off, we're going to be starting with, it's Duolingo. This is a stock that I bought a 2% position in, and everyone went crazy online. Now it's one of the most discussed stocks online. In fact, in Qualtrim, it was the #1 most searched stock last week. So I don't know what I started here, but Duolingo has now made it out to the masses. When we look at Duolingo, and I try to be honest with the moat here, there's a couple things I can look at. First of all, Duolingo is growing very fast. It has 40% revenue growth. The subscription growth is growing 47% year over year. Their daily active users are growing year over year. Their monthly active users are growing year over year. Their paid subscribers are growing year over year. Now, growth doesn't equate to a moat, but if a company grows this quickly and they continue growing to tens of billions of dollars, that equates to a moat. That means they have some competitive advantage. We also know that Duolingo has the huge majority market share in ed tech, meaning educational technology. They own that market, over 60% of the revenue. So Duolingo owns this market. They do have a moat so far. And that moat's currently being challenged by the big tech rival, Google. They've built a language learning application right into Google Translate. And this is what's causing all the questions and discussions about Duolingo. So right now, when I look at this company, it's not a stronghold. Let's be honest here. It's not that proven. It needs more of a robust history, and we have new competitors entering into the fields. In fact, I wouldn't even put this one as a castle wall. I'm going to put this one right now as a wood fence. They've certainly had a moat so far, they're growing quickly, but there's still questions about the future, whether or not companies like Google can start carving out their own market share. With those questions and uncertainties, I put them right in the middle. Next up, we have Lululemon. This is the worst performing company in the S&P 500 year to date. If we look at the price action, it's down 55% so far this year. So not a good year for Lululemon. They've had a slowdown in revenue. They're blaming it on tariffs and other factors, but it's true that right now their sales in North America are slowing down dramatically. Now, maybe this is a bit unfair, but I'm going to put Lululemon in the open field category. I think they're in a highly competitive industry. I don't see any substantial moat. They got brand value, but there's other brands like Alo Yoga and Viore, you name it, competing with Lululemon. They're having to sue competitors like Costco for selling similar items. This is an incredibly competitive field. They don't have dramatic ownership of this market. And as athleisure becomes increasingly competitive and saturated, you're seeing the struggles with Lululemon. Next up, we have another popular company that's come onto the scenes in just the past year or so, which is Hims & Hers, the fast-growing telehealth company. It's subscription-based, and they're trying to reinvent pharmaceuticals. Now, there's lots of big, grandiose thoughts and promises and thesis about this company, and it's one that's had dramatically good performance over just the past year or so, up 260%. So it has growth. But growth doesn't always equate to a moat. While most of the metrics are moving up incredibly fast, we can see the revenue growth over time, we can see the total subscribers ticking up every single quarter. These are all great to see. With Hims, I'm still concerned about the long-term defensibility of this business model. There are going to be a lot of competitors, and they're operating in a space that has a lot of litigation, a lot of uncertainties. With all of these type of products that they're selling, they can be recalled, there can be lawsuits. It is very unpredictable what happens in pharmaceuticals. I'm going to put Hims as a picket fence. I think it has a moat. It's growing over time. Maybe it will get to a wood fence soon, but with the market they're competing in, I believe it's very unpredictable. Next, we have Palantir, one of the fastest growing companies in the market. It's at a massive market cap now of almost $360 billion. So Palantir is a massive company by market cap size, and that's on the basis of the rapid growth this company has. Palantir has been able to expand their growth, accelerate it over time faster than investors have expected. They're gaining US customers at a rapid pace. We can see that in the chart here. It's growing 64% year over year. And these customers pay Palantir a lot of money. They have an expensive product. So these are very valuable customers. Palantir also has long-term contractual agreements. They're deeply embedded with the companies or the government that they do business with. They're diversified between customer base and the US government. So overall, the moat of Palantir has continued to grow. Palantir right now has a wide moat, a castle wall. It's not quite a stronghold, but it's getting close. Next up, we have AMD. This is one that often comes up in conversations when investors have talked about missing out on Nvidia. Well, maybe AMD's a new opportunity. And that's been the investment case for it. One of the critical things that AMD lacks that Nvidia has is this whole ecosystem. Nvidia has CUDA, the code and the ecosystem, the software that supports all their products. They sell everything end to end. So the contracts that Nvidia have box out AMD just by virtue of their entire ecosystem. So right now, AMD has nowhere close to the same size of moat of Nvidia. But that's how the market works, and that's the reason that AMD is a lot smaller of a company than Nvidia. When I look at this one, I'm going to give it a wood fence moat. Now, next we have MSCI. MSCI is a wonderful business. It's one that I've been looking at for a long period of time. It's been on the watch list. And in a lot of ways, it's very similar to S&P Global. You can break down the revenue of this company into these different segments. You have the index business. They have the MSCI World Index. Lots of ETFs linking to it. They earn a small fee every time that happens. So you have this business, which is by far the most important. Then, of course, they sell a lot of data. They have customers with analytics. That makes up around the other 40% of the company. Then you have ESG and climate. So it's diversified between these two major segments. I'm going to put this one as a castle wall. It's a very solid moat, fast-growing company, diversified to some extent, but it's not quite as big and robust to become a stronghold. Now, next up, we have UnitedHealth Group. This is one that's gone through a sell-off. We have Warren Buffett entering into a position, but it's still not recovered back to its recent highs. And that's because of the mispricing of many of its plans. This is a simple, straightforward health insurance company, but it's at such a monstrous scale in the United States that it's virtually part of the overall system. It is the system in and of itself. Its networks are so deep and wide that at this point, it's incredibly difficult to disrupt. This is another one that I could put either in the stronghold or the castle wall like MSCI. I'm going to put it slightly below the perfect moat because it does face some potential disruptions with challengers to its business model as well as government intervention. Now, next we have Target, the retailer. This has been one of the most mismanaged businesses over the past 5 years. Management had a lot of woke stuff in their stores that made conservatives mad. Then when there was backlash about that, they removed it all. That made liberals mad. So they somehow found a way to offend both sides of their customer base. Now neither side likes them. On top of that, they don't know what direction to go with their pricing. Are they premium? Are they value? Do they compete with Costco? Do they compete with Amazon? Their online sales aren't growing as fast. This company has faced misdirection and challenge after challenge. Retail is fiercely competitive, and for a company like Target to have any type of moat, they need to be doing something special, something unique. There's other companies in retail that have figured it out, but Target's struggling to. For that reason, I'm putting it in the lowest moat category, which is the open field. Next up, we have everyone's favorite, Tesla. Tesla's a company that's deeply complex. They're a car company, a robotaxi company, they're a solar company, they're an energy company. They have their hands in many things, but overall, the top line growth has decelerated to a decline. It's now down 2.7% year over year. When we look at the revenue by segment, their vehicle sales are down. BYD, the Chinese EV car seller, is outpacing Tesla dramatically in their car sales now, growing much faster in China and even other places. Tesla, of course, is refreshing their models, and they have the Cybertruck, but that hasn't been enough to refresh their sales numbers. Tesla's valuation is becoming more increasingly justified by future potential bets, like the robotaxi. But when we look at companies like Waymo, we can see that Waymo is the only one that's really growing with paid robotaxi rides. And they're doing it without employees in the vehicle. They're doing it without any catches or caveats. Another one that's testing out robotaxi this year, in fact, they have autonomous rides right now, is Zoox from Amazon. Selling vehicles is a highly competitive business. And for Tesla to have a true large moat, it'll need to show that it can run real robotaxi rides without employees or any catches to it. They'll also need to have more of their revenue come from those type of things, not from selling their vehicles. Next, we have S&P Global. Now, this isn't the S&P 500, but they are the owners of the indices like the Dow Jones that runs the S&P 500. So they make money anytime an ETF links to the S&P 500. They also make a fortune selling data and analytics. They also, on top of that, have an entire business rating the debt of companies, which the debt markets are dramatically bigger than the equity markets. So S&P Global is a diversified company in all wide moat businesses. They have mission critical data, they have analytics, they have indice business, they have credit ratings on global data. They're like a gatekeeper or a toll booth for all of this information. When I look at this company, it's difficult for me to find one that has a true wider moat. S&P Global is going to be the first stronghold. After that, we have Salesforce, a company that's been under pressure this year. It's the biggest loser in my portfolio, enormously negative sentiment as growth has decelerated, and there's a lot of talk of software being eaten by artificial intelligence. That's a narrative that's playing out in the market. Now, Salesforce is an incredibly large-scaled company in all different segments. You can see all the various services they have, from the Sales Cloud, Service Cloud, platform. They have a whole apps business, marketing and commerce, integration and analytics, and then they have non-SaaS but professional services as well. This makes up the entirety of Salesforce. Salesforce is a company that I'm going to put in the middle category. It's a wood fence. It's a strong moat, but it's not impenetrable. And there are questions of what's going to happen in the future. Next up, we have Nvidia, the dominant king of the lucrative GPU market. When we look at the market cap, in fact, it illustrates how much of a distant second AMD is. Nvidia has a $4.1 trillion market cap. AMD's at like 250 billion. They're not even close. Nvidia owns this market. Now, when you look at any of the numbers right now, Nvidia looks like it's the biggest moat in the world because they have the most money, the most revenue, the most operating margins. But the question I have for Nvidia is, how durable is this moat over the next 10 or 20 years? It's good right now, but is it just cyclical? Will competitors start making their own GPUs and chips? Google already has their own custom solutions that dramatically reduces their dependence on Nvidia. Now Amazon's doing the same thing with Trainium. Amazon doesn't want to be paying Nvidia as much as they are, so they're designing their own chips as well. Remember when Intel looked like it had the biggest moat in the world? At one point it was indestructible, but then Apple designed their own chips. They came out with Apple Silicon and they dropped Intel. That was a massive blow to that company. So while Nvidia looks incredibly strong today, there is some long-term durability questions. I put this one in the castle wall category, right below stronghold. Next, we have Nike. This is a company that, like Lululemon, like many of these fashion companies, it relies primarily on brand value, the Nike logo, the history of the company. Nike is a company that amongst brand value companies, it's one of the best. The Nike logo in and of itself is worth so much because of the history of the company. But when I look at this type of business again, Nike is struggling in its sales. There's other companies that have pushed their brand value way up. You have companies like Adidas signing major sports figures, which Nike used to own that market. I like Nike, I like the brand, but I think it has a weaker moat than most companies that we're talking about today. It's still good when you compare it to the average company, but we're talking about really top tier companies here. Nike's future growth and the competition they face leaves a lot of questions. Next up, we have Netflix. Now, I'm a little bit biased on this one, of course, because it's my largest position. It's my biggest winner. Netflix has been a company that's exceeded most people's expectations, but it's a company that I love for a lot of different reasons. The predictability of the subscription business, the cost structure of the company for paying for content up front and then reaping all the benefits down the road. And they've consolidated all of long-form episodic media. They have the content that when you go to the couch, you want to relax on the big screen at night, you usually turn on a Netflix series. This company has won. They won the streaming battle. They have over 300 million subscribers. At this point, it's probably close to 315 million. They're extremely free cash flow positive. They can push money back into content and have this flywheel continue and continue and continue. And as much as their competitors try, despite their best efforts, Apple TV, Amazon Prime Video, Paramount Plus, they're not stopping Netflix. I think given the global scale, the predictability of revenue and income, and the market position that this company has, I believe it's a stronghold. I've said this for years, but Netflix already won this battle, and I think their moat's unassailable. Now, next we have Microsoft. I'm not going to spend too much time on this one. I mean, come on. This company has near perfect fundamentals. Just look at any of them. Everything goes up and to the right. The cash flow, the earnings, the balance sheet is pristine. The shares outstanding go down over time. They return more and more cash. They generate more revenue. They're diversified across all different segments, geographies, customer base. This company has it all. Microsoft is one of the biggest winners over the past 20 years. Microsoft has been so dominant under Satya Nadella and I think that it's going to continue with its supremacy. It is a stronghold. After that, we have Intuit, which is a company that a lot of people underestimate the moat of. They have enormous dominant market share of do-it-yourself taxes, of small business accounting. Then, of course, they have Credit Karma, which is incredibly fast growing, and they're moving upstream to mid-market. When you put all the pieces together, Intuit has a very wide moat, but it's still a software company. They're still competitors to everything they do. On top of that, we've seen evidence that Intuit's revenue has actually accelerated over the past year, not decelerated. So it's gone back up to 16%. We're seeing revenue acceleration because of artificial intelligence. It is helping this company, not hurt it. Because of how concentrated Intuit is and how many different sectors they compete in, I believe their moat is a castle wall. Next up, we have Meta, a company that when I first did analysis on it, I got it wrong. I looked at Meta as a social media company. And on the surface, that may look like what Meta is, but in reality, it's a lot more than that. It's the network by which everyone communicates. It's like the railroads of communication. It's the infrastructure of communication. In fact, I'd look at Meta as more like the Class 1 railroads, like the Union Pacific or Canadian Pacific of communication across different people across the globe. Because when you look at Instagram, Facebook, when you look at Reels, when you look at Threads, all the different assets that they have, they built out the biggest network of communication in the world. Meta goes firmly in the stronghold category. It's difficult to find a company that has a bigger moat. Now, next we have Mastercard, and you could also bucket Visa into this one as well. My comments would be virtually the same. Mastercard's a company that has so many cards, so many users, so globally diversified, and they're so adapting to different technologies like stable coins or cryptos. They're also including that in their network and settling transactions. When we look at this, they just grow and grow and grow with global economies. When I look at Mastercard, I think it belongs firmly in the stronghold category. Right now with Mastercard or Visa, we just don't see any weaknesses. Next, we have Google, a company where the moat has been the topic of debate for the past 6 months. A lot of people said that Google is the new Kodak, the new eBay, a company that the moat was being eroded by LLMs like ChatGPT. But Google's done a good job of changing the minds of those commentators by steadily growing every single quarter, quarter after quarter. Google's in a fast-moving, highly disruptive industry with lots of changes. Even though the company's incredibly good, it's full stack, from all the infrastructure to the models to the distribution, I still believe because of how fast-paced this industry is, because of how many challengers they have, it's not quite at the stronghold level. I think that Google is moving upwards. The moat is getting more strong over time, but I'd put it in the secondary castle wall category. Now, next we have FICO, a company that's also had its moat challenged over just the past few months. As a new government housing official, I specifically targeted FICO and their business model, trying to make changes to introduce more competition. This has caused the stock price to drop, but the revenue continues to grow. When I look at FICO, I think that the moat overall is incredibly strong, but there are some potential weaknesses in the armor. And that is the fact that FICO has raised prices so aggressively and so visibly. It's so apparent that it's drawing a lot of attention. Because as regulators look at this company, they could enact laws and regulations and changes that make this company less profitable. So I'm putting it below the stronghold into the castle wall. We'll see how things pan out over the next year, but right now I think this is appropriate. Next up, we have Equifax. This is a company that I've been investing into recently. I think it's a fantastic company that's diversified. Of course, they're one of the big credit bureaus. So when you get a mortgage, you have to get your credit pulled and they provide that data. But then they also have workforce verification services. So if you're hiring someone or you want to see their work history, you can use their tool to instantly verify their work history. When we look at Equifax and compare it to FICO, Equifax doesn't have quite the monopoly that FICO has, but it also has a more diversified revenue stream and product base. So the dynamics of the moat are different, but I think they're fairly equal. Next up, we have one of my favorite companies. In fact, I've called this one the best business model in the world, and I say that unironically. It's Costco. And if you have a Costco membership, if you've shopped there, you'll know why. Costco's a company where people criticize the moat because it has low margins. And they say that low margins are evidence that the company doesn't have a big moat. While that may be true in most cases, Costco is a unique business in which the low margins are the moat. That's what makes them so difficult to compete with. Nobody can do what they're doing at scale and offer cheaper prices. So the fact that Costco can continually undercut everyone, and the fact that everything they sell in their warehouse is meaningfully cheaper than everywhere else, is their moat. The way that they monetize is by their cardholders, by their subscriptions over time. And you can see that grow. So they charge a small fee every year. That's where they make their money. and then they undercut everyone else with their pricing. I believe that Costco is in the highest category with a stronghold. There's only about 2 companies that meaningfully compete with Costco, Amazon and Walmart, and they're not able to replicate exactly what they're doing. They take a different approach. Next up, we have Disney, which is a highly diversified company across all different revenue segments. We have here entertainment, sports, and experiences. So you have the box office movies, they're big blockbuster movies. You have sports, which includes ESPN, which they're always changing and selling and licensing. And then you have experiences, which of course are their parks. Disney's a highly diversified company, but I actually believe the moat is much weaker than what investors price in. The fact that this company has gone 10 years without significant gains shows that it's highly competitive. It's difficult to grow. Their pricing power is limited. In fact, Disney has trouble expanding because they're competing with Universal Group with parks. On streaming, they have bigger competitors like Netflix. ESPN also has growing competition for sports rights as big tech enters into it. And their cable TV networks have been shedding subscribers for years. So this company, I believe, is in a tough position. Every vertical that they're in has a lot of competition. Next, we have Chipotle, the burrito bowl company. This one is one that I used to own. I sold it at around 55, and in fact, it's sold off a bit since then. This is one that I made quite a bit of money in a short amount of time. It's actually one of the better investments. But Chipotle's been a company that's been struggling recently because of an increase in competition. And frankly, the management has done everything they can to make more money in a short amount of time. I believe Chipotle has a moat, but I think it's in the weaker category. I'm going to put this one down into the picket fence as well. They just face so much competition. The amount of quick service restaurants seemingly grows every day. Next, we have Booking Holdings. This has been another company that I've really loved. It traded at a low valuation. The growth has been incredible. I've said for a while that Booking Holdings is like buying a license on the human need to travel. And humans love traveling. It's something we're never going to give up. No matter how many wars or pandemics or what may happen, people are going to want to travel. Now, there are some challenges or potential challengers to Booking Holdings' business model. One of them is that the company is reliant on Google advertisements and funnel. Google is actively competing with Booking Holdings. Another one is that they do have competitors like Expedia. So even though I think Booking Holdings has a relatively strong moat, it's not in the same elite category as S&P Global or a Netflix. It's just not quite at that level. Now, next we have Berkshire, Warren Buffett's empire that he's built up over a long period of time. It has numerous businesses that are wholly owned. He has railroads. He has a huge energy business with tons of oil companies. He has companies like Geico. He has companies like See's Candy. It goes on, just dozens of wholly owned companies. Then you also have their public investments. And Berkshire's a company that's just steady. All the time, they're growing revenue, they're growing operating income. Berkshire is firmly in the stronghold category. This is a company that's so diversified and the businesses are all so cash flow positive that it's virtually indestructible at this point. Now, next we have Broadcom. This is another company that's gone through a huge winning streak. It's one of the best performing stocks in the market, and that's because much of this industry that's growing relies on the products of Broadcom. Now, their revenue has been speeding up like crazy. You can see the acceleration right at the tail end of 2023. If I had a criticism for Broadcom's moat, it would be the reliance on Apple. We've seen that Apple can dump their suppliers over time as they vertically integrate, so that outlines a risk for Broadcom, but overall a very strong moat. It's in the castle wall category. Now, next we have ASML, which is the maker of the most complex device on earth, which is the machines that cost around $400 million, the extreme ultraviolet lithography machines. They are necessary. In fact, they're a requirement for TSM and Intel and all those companies to make their fabs. What ASML has figured out is how to make 2 different little indentation patterns 2 nanometers apart. For reference, that's about 20 atoms apart. And that little scientific challenge there is very difficult for anyone else to figure out. In fact, it's taken ASML 20 so years to figure it out. And the requirements to do so are difficult. They have machines that have over 100,000 parts. They require 1,200 unique suppliers, of which ASML has a lot of exclusive agreements with them. One of them is a German company called Zeiss that makes glass so perfectly flat that they're the only ones that can make it in the entire world. And that's an exclusive partner of ASML. On top of that, they also have deep network effects. They're deeply embedded in the process of their partners. For example, when TSM and Intel draw out the roadmap for their design plans and their building out of new factories, they do so with ASML because they can't implement what they're doing without their product. From all available information today, ASML is firmly in the stronghold category. And even nations that get state funding like China are having a lot of difficulty trying to catch up to what they're doing. Now, next we have Apple. This is one where it's pretty simple. Apple has a strong moat because of the iPhone. The iPhone is still king. And unless that changes, unless there's another device where people use it more than the iPhone, Apple's going to remain in that position. When I look at potential devices that could disrupt the iPhone, I can't think of any because most of them are screenless, like audio devices. But there's a lot of things you just want to read because you're looking at it discreetly. You don't want to have to talk to it. So the iPhone still remains, I believe, a durable moat for a long period of time. Now, Apple does have challengers to their moat over time. They have Huawei, they have Android, but I think that Apple still remains in a stronghold position. It's incredibly difficult to compete with. They are saturated, they're growing slower, but with a huge moat. Next, we have Amazon. This company has a massive moat, and I believe that it's underappreciated by the market. Even though Amazon stock is going up, I think it has more room to run, because when we look at what this company actually owns, their market share, they're the biggest online retailer in the world. They're the biggest cloud computing company in the world. They're the company with the biggest fulfillment infrastructure in the world. They're the second largest streaming company in the world. They have the third largest advertising company in the world, and so on and so forth. Amazon is near the top of so many verticals that it's difficult for me to find a company that has more optionality, more big markets that they can move into. When we look at this one, I think it's firmly in a stronghold position. They do face competitors, but their market share speaks for itself. They are massive in multiple markets. Now, next we have Adobe. This is a company that has that tale of two narratives. There's a lot of debate on this one because Adobe's growing its revenue. The metrics look really good. Everything on paper looks really good today. In fact, it's growing quite fast. But when we look more qualitatively, Adobe's facing a lot of competitors. There's companies like Canva on the low end competing with them. Then you have companies like Gemini and other models making image editing easier and easier. That brings into question how defensible Adobe's moat is. So this is one that has a lot of questions regarding it. I believe that Adobe does have a lot to prove over the next year to prove its moat. I think it's in the same category as Salesforce. Right now, it looks good by the numbers. It continues to grow, but there's just a lot of questions of how durable this one is. Now we get to one of my favorite businesses, Texas Roadhouse. If you haven't ate there, I think you should try it out. It's great food, great service, a really fun environment for an affordable price. Texas Roadhouse's moat has been the brand value, the experience, the execution over a long period of time, and the trust they have from their customers that every time they go there, they're going to have a good time. That's the basis of the moat. Now, they have many competitors. Any type of food business is going to have 1,000 competitors. But when they continue to execute like they have, they've had long-term great results. In fact, very predictably great results for a long period of time. But like any restaurant company, it's not the strongest moat in the world. They face so many competitors that are evolving their value propositions all the time. You can see the changes that Chili's have made. You can see the changes that Cheesecake Factory have made. They're all trying to improve their business and compete better with Texas Roadhouse. Finally, we get to Uber. This is one where the numbers, again, speak differently from the pricing of the company. The company trades at a higher free cash flow yield and a low multiple relative to its growth, because this is one that has some questions about their future durability. Although Uber is highly profitable and growing fast, there's still that lingering question of if they can compete with Waymo or Zoox. And if Tesla finally gets to the fully functioning robotaxi, will they be able to compete with all of them? How much will these big technology competitors eat into Uber's market share? That's what keeps the valuation down for this company. Now, with any type of company like this that has a lot of debate, it means there's more opportunity. But for right now, Uber still needs to prove it. Over the next 2 years, as these robo-taxis and the technology becomes more available, Uber needs to prove that they can defend their moat, they can integrate partners, they can still maintain that big monopoly position in the network business. And this wraps up the final rating on each of these companies. We got a lot of great companies here, so it's hard to rate them against each other, but I think I got it pretty accurate. If you disagree with any of these rankings, let me know. And if you want me to rank other stuff in the future, just leave me a comment. That's going to be it for this time. See you in the next one.